Welcome back. Keeping it with the UBS conference, we also spoke with Sunil Tirumalai, Global Emerging Market Strategist at UBS India, on his global and Indian market outlook. Listen in.
Yes, it's a very interesting time. So particularly for the India context, after a year of deep underperformance, the things which are changing are corporates, giving you any positive signals. That's something that we are really keen to understand over the next couple of days. I think coming to your question on our positioning and in our underweight position on India, there are a few reasons behind it. Right. If we actually look at the last 3-4 years of actual fundamental performance that we see, delivered by companies in India, the listed companies, the large companies in the index, you actually don't see any extraordinary growth or either on top line or on earnings. It's pretty much in line, if not a tad lighter than the rest of emerging markets. The markets which are actually doing far superior are the tech markets like Taiwan, Korea, China too. And I think it also starts with the fact that the nominal GDP growth has actually come off significantly. And that matters a lot more for stocks, for top lines, for earnings, etc. Till let's say pre-COVID, or even till 2 or 3 years ago, India's nominal GDP growth was head and shoulders above other emerging market peers. But now it's not. There are other markets which are very within touching distance, right? So while that could stabilize and there could be some improvement, we don't see a catalyst that can take it back up to 12-13%, kind of, nominal GDP growth. In the absence of that, the valuations are actually, reasonably rich. So, in our numbers, historically, India used to trade at a 35-40% premium to other emerging markets. It's now, even after a year of underperformance, it's still at a 60% plus premium, right? Now, in the context of all this, I mean, the report that you're referring to that came out this morning, actually, we've done a lot of work on the AI theme itself. It's a global effort, trying to understand where we are in the cycle, how much, more to go at a global level, and which countries, which stocks are more exposed, etc. India is conspicuously absent, on that theme, and I think that's something that, from a global investor's perspective, other markets like China, like Taiwan, like the Korea, which are giving you better opportunities. Now, the specific question on, the secondary market versus the primary market, I think that's actually one of the reasons for the underperformance of the secondary market. So if you actually see, no doubt the flows of household money into the stock markets is continuing. SIP investments, the flows are fairly high. They're not going much higher anymore. I mean, they're kind of showing signs of plateau. But the other interesting change is that the capital raise activity by corporates is actually shot up significantly. I mean, when we did some numbers pre-COVID, the total on a run rate basis, about 10% of the money coming in through SIP and mutual fund flows and other direct flows into the market from households, about 10% of it was the scale of corporate demand for equity capital. Now that number is touching 25%, and combine that with the fact that foreigners are also, not excited. They are finding other, markets to invest, and hence money being taken out of India. That's what is preventing the secondary, market to do well. So you have a decent supply of paper. I mean, all these IPOs are good. They're really good headline, material. But it also means that's money being taken away from the market.
Sunil, you're building a very believable, compelling bear case, justifying that call. So therefore, let me ask you, and we are barely, 3-4% at the index level, we're barely 3-4% away from the all-time highs. Given all the negatives that you described, the fact that MF flows have slowed down, there's no two ways about that, and FIIs have not returned, is there a possibility of some price correction in India? So far, it's largely been time correction. What do you see ahead for the broader market, for the index?
Okay. So let me take a step back. From a global perspective, we are reasonably positive on global equities. right? So, there's on S&P 500, there is a 10-11% upside till end of 2026. On our emerging markets target, it's a tad lower. So we are actually arguing for the US regaining leadership. The setup globally for equities is reasonably good. Global macro, on our economist numbers, US economy should start, revving back up and, accelerating in the back half of next year. China numbers, while they are slowing down, they have actually been upgraded from what it was a month ago for the next year. And in this context, where are valuations? And let's look at the rates market. There is an anticipation that potentially the Fed could start expanding their balance sheet. There will be stable coin demand in the US. I mean, all of that will keep yields in check. So it's a reasonably benign environment for global equities returns, right? So I think it will be really hard for more than a 5% correction, in the market. Of course, we need to be clear about a dollar correction versus a rupee correction. Our call is for the rupee to depreciate till end of next year. But keeping all of those things in mind, I think it's more likely that the time correction will continue rather than a very sharp, price correction, because the supply of money from households is still continuing. That's a fantastic buffer, for the market. It makes it, very defensive and very protected against a big correction.